Hi, and welcome to Style Investing, What's the Best Approach for ETF Investors, the latest installment of the IndexUniverse webinar series. I'm Matt Hougan, President of ETF Analytics and Global Head of Editorial for IndexUniverse, and I'll be your host for today's webinar. I'm pleased to be joined on the call today by Tony Davidow, Managing Director and Strategist at Rydex SGI, as well as Ron Ruff, the Director of Portfolio Management at Financial Services Advisory. Both gentlemen will be joining us in the Q&A today to share their decades of experience with size and style investment decisions. I'm also pleased to be joined today by Paul Baiocchi, our ACE ETF analyst here at IndexUniverse, who will be sharing the hosting duties with me. This is the latest in our monthly series of webinars we dubbed the Alpha Beta series. For these webinars, we aim to provide complete 360-degree analysis of how to invest in different asset classes and styles using ETFs. The format today is very straightforward. Paul and I will kick things off with a 20 to 30-minute presentation covering various approaches to investing in style ETFs. We'll cover the beta portion of the Alpha Beta webinar. Following our presentation, we'll bring in Ron to discuss how he actually uses style funds in his practice and where he sees style investing going today. We'll end it by bringing in Tony and having an in-depth roundtable style Q&A on the topic of style funds, style ETFs, and style investing in general. As a participant in this webinar, you can enter questions for any of the panelists using the comments tool on your webinar screen. Please do not wait until the end to ask questions, but submit them, rather, as they occur to you. We'll collate the questions submitted throughout the webinar and answer as many as we can at the end. I'm very excited about this webinar and especially pleased to have Ron, Tony, and Paul joining me today. As someone who works for a company called IndexUniverse, I can tell you that there's a common perception out there that indexes are essentially commodities, that they're boring, or to put a finer point on it, that they're in fact fungible. Investors assume that one index and ETF can be swapped for the next, that whether you use this large cap index or that large cap index, your returns will be more or less the same. And I think that's especially true when you look at style. Style investing, growth, value, core, has a bit of the Potter-Stewart curse. If you ask an investor how to separate growth and value stocks, most would say something like, I don't know, but I know it when I see it. Apple, a growth stock. Dow Chemical, value city. But Paul and I, being true index geeks, know that there's no such agreement. Different index providers use completely different factors to separate growth and value stocks, and there are hundreds of stocks that one provider considers growth and another provider considers value. As a result, different indexes and the ETFs that track them have vastly different performance. We're going to see some slides that demonstrate that as we move through this webinar. As Paul and I sat down to prepare our slides, we realized that we needed to start from the top and really drill down on how different index providers, and therefore different ETFs, make the fundamental choices to segregate the market into growth and value. Because if we do that, then investors like you can make informed decisions about which one is best for your portfolio. And if we are going to start right from the top, we might as well start right from the top, which in style investing means the groundbreaking work of people like Benjamin Graham and T. Rowe Price. Without them, style investing would not hold the place in the investment community that it does today.
Value investing actually predates the Great Depression, with its origins deeply rooted in the Columbia Business School curriculum of the late 1920s, pioneered by Benjamin Graham and David Dodd. Although it would not be until 1934 that Graham and Dodd penned what would become the Bible of value investing, Security Analysis, and another 15 years until The Intelligent Investor was released, the wheels were already in motion. Value investing was, in many ways, a challenge to efficient market theory. It posited that prudent financial statement analysis could yield abnormal returns, as the market undervalued companies for a multitude of reasons. The most lasting contribution of this book to the field of security analysis was the emphasis placed on the quantifiable aspects of security analysis, such as evaluations of earnings and book value, while minimizing the importance of more qualitative factors, such as the quality of a company's management or the buzz surrounding one's product. Perhaps the most well-known theme presented by the now famous pair of Graham and Dodd was the idea that investors should buy companies whose stock price is trading below its intrinsic value. This hypothetical value, also known as book value, forms the basis for many value index strategies today. Indeed, Graham and Dodd's work spawned the invention of the price-to-book value ratio, one of the most popular metrics in style investing to this day, some 80-plus years later. Security analysis and the intelligent investor have been lauded by some of the most sophisticated and successful investors in the history of the market, the most well-known of which is the great Warren Buffett. Perhaps more than anyone, Buffett brought the theories of Graham and Dodd to the forefront of investment culture. After managing a multitude of investment partnerships, Buffett left to run Berkshire Hathaway in 1969. 15 years later, he penned one of the most controversial investment letters of our time, The Super Investors of Graham and Doddsville. The article, which ran in the Columbia newspaper Hermes, challenged the idea that markets are efficient and pointed to 9 successful investment funds, all of which were run by alumni of Columbia, all of whom were students of Graham's, and all of which followed the value investing formula set out by the famous Columbia professor. First and foremost, he underscored Graham and Dodd's core theory. The higher the margin between the price of undervalued stock and its value, the lower the investor's risk. On the opposite, as the margin gets thinner, risks increase. Finally, analyzing the backgrounds of 7 successful managers, he made the conclusion that an individual either accepts value investing strategy at first sight or never accepts it, regardless of training in other people's examples. Quote, there seems to be a perverse human characteristic that likes to make easy things difficult. It's likely to continue this way. What Warren Buffett did with his article was bring the concept of value investing back to the mainstream at a time when the market was flying high and speculation was rampant. Now, right around the time Benjamin Graham and David Dodd were developing their efficient market theory busting strategies, T. Rowe Price was busy creating his own. After founding his firm in 1937, Mr. Price gradually developed the strategy that would become the basis for modern-day growth indexes. What Price believed was that investors could earn superior returns by investing in well-managed companies in fertile fields whose earnings and dividends could be expected to grow faster than inflation in the overall economy. Price targeted growth by focusing on firms with superior research to develop products and markets. Price was looking for a lack of cutthroat competition, a comparative immunity from government regulations, low total labor costs, but well-paid employees, at least a 10% return on invested capital, sustained high profit margins, and a superior growth of earnings per share. Today, he might have built an index to underlie an ETF, but in 1950, Price instead opened his first mutual fund, the T. Rowe Price Growth Stock Fund. Mr. Price's ideas were later justified by the work of Eugene Fama and Ken French, 2 pioneers of market theory. Under the model developed by Fama and French, the traditional CAPM model was expanded to include factors modeling the impact of small cap and growth exposure in a portfolio, 2 of the factors they found to be predictive of returns. The growth factor, calculated using the price-to-book ratio, said that companies with high book value to price ratios would enhance returns. This was based on years of research the pair did in an attempt to further the ideas of an efficient market. It was ultimately their conclusion that growth stocks showed a statistically significant excess return historically, and the CAPM model should be expanded to accommodate that. Thus, the growth theory that Mr. Price fought so hard to preach was justified by the academic works of Fama and French.
And given what most people know about style investing, it seems like it would be easy to build a style index based essentially on those insights from the founders of it. You know, after all, if price to book was the only factor Fama and French needed to distinguish a growth stock and a value stock, Why not just divide half the market by PB ratio and be done with it? The answer, though, and this pertains to how investors approach style investing today, is it's not that simple. Securities research didn't stop with Fama and French, despite what some investors will tell you. And in today's real world of complex accounting and advanced statistical correlation analyses, index providers have moved past simple price-to-book splits in an attempt to build a better mousetrap. At the core of this effort to divide the market into growth and value today lie two goals. First, to divide the market in a way that create two, or three if you include core, truly distinct sets of companies that produce measurably different patterns of returns. To do so in a way that captures growth and value factors as the critical drivers of those returns. It might have been simple in 1950, but today there are dozens of different ways to approach the problem. We're going to run through a number of them here to give you a survey of the field. Let's start with Russell. Russell Investments is one of the world's leading index providers, and their growth value methodology is probably the closest to the original simple Fama and French that we have today. Russell's growth and value indexes are based on just two factors. So we were talking about Russell Investments. Russell is one of the world's leading index providers, and their growth value methodology is probably the closest to the original simple strategy of Fama and French. Russell's growth and value indexes are based on two factors, the price-to-book ratio and long-term forward growth estimates. But unlike the old method, which would simply draw a black line in a long list of stocks and put all the ones above the line into growth and all the ones below the line into value, Russell thinks the two factors should be evaluated independently. In other words, it thinks PB defines value stocks, but long-term earning growth estimates define growth stocks. So what happens if you have a low PB stock that's growing like Apple? Well, since Russell uses each metric independently, companies do end up being allocated to both the growth and value indexes. In this case, Russell would divide the market cap of these blended stocks, assigning some to the growth index and some to the value index. FTSE's system is much the same, just with more factors. FTSE, I think to their credit, uses both historical and forward-looking metrics to determine and separate growth and value companies. For value, then, it looks not just at price to book, but price to sales, price to forward cash flows, and dividend yields. For growth, as you can see, it uses a variety of factors. Again, like Russell, these metrics are all screened independently, meaning companies may end up being classified as both growth and value. Both this and the Russell methodologies are evolutions in and of themselves. By using forward-looking metrics as opposed to historical measures, they take a future glance into what drives growth and value performance. One thing that's interesting about FTSE's approach is its heavy focus on sales, which are at least easy to measure from an accounting perspective. FTSE uses three different sales metrics, two of which are in the growth calculations.
And as much as FTSE is focused on sales, MSCI is centered on earnings. MSCI uses three metrics to screen for value and five metrics to screen for growth. The MSCI Style Index series uses a wide array of forward-looking metrics, one of the common early-stage style improvements in the style indexing strategy away from the original Fama and French model. As with the previous providers, MSCI's system produces growth and value indexes with overlap. While there are companies that are classified as only growth or value, there are also companies classified as both, something that we will see can cause higher correlations between a growth and value index within the same family. Now, the Dow Jones and Wilshire suite of style indexes are a great example of an index provider's willingness to adapt. Historically, the Dow Jones-Wilshire family of style indexes used only PB and price to earnings to split the market, with price to book given 3 times the weight of price to earnings in determining where to split the market. Of course, both of these metrics are backward-looking. But in 2004, the two firms changed tack. developing an expanded set of metrics to divide the market, including two forward-looking metrics, projected price-to-earnings ratio and projected earnings growth. While the use of estimates creates a certain degree of risk, studies show that these are in fact drivers of style factor performance. Standard & Poor's, meanwhile, shows a similar evolutionary change. Prior to 2005, S&P used the same old model for style index creation that was run into the ground by so many providers. In fact, it was nearly pure Graham and Dodd. The firm would split the entire market based on PB, and then market cap weight the constituents. However, beginning in 2005, S&P developed two new types of style indexes. The first is a more traditional version, updated with new metrics, using sales growth, earnings change to price, and momentum factors to isolate growth stocks, and price to book, price to sales, and dividend yield to isolate value stocks. This series also has the overlap problem, with companies classified as both growth and value firms. On the other hand, the second series of indexes it released, the quote-unquote pure style series, represented a significant evolution in the segment. Under this methodology, S&P used the 6 new metrics to score each company based on its value or growth quotient. The companies which achieved the highest 33% of growth and highest 33% of value scores were put exclusively into the pure growth and pure value indexes, respectively. Those companies who make up the quote-unquote core were placed into style purgatory, excluded from both indexes. What this series of indexes does is create, as their namesake promises, pure style. S&P takes it one step further by style weighting the indexes, abolishing the tried and true practice of weighting by market cap, but instead assigning a higher weight to the growthiest stocks in the growth index and the valueiest stocks in the value index. By isolating the pure style series, S&P aimed to create indexes with more distinct patterns of return. Indexes that were more different from one another and that caught and amplified the growth and value factors that investors were seeking. The innovation has not stopped there. One recent and potentially important new set of indexes are the RAFI Pure Style Indexes. What S&P did with their style index makeover, RAFI took one step further. Under the RAFI system, style scores are calculated as the difference between a company's composite growth score and its composite value score. The composite growth score is computed for each company as the average of each of the 4 growth factors. For each company, growth factors are year-on-year percentage changes in sales, cash flow, dividends, and book value. Each factor is averaged for a 5-year period. For example, the sales growth factor is the average of the past 5-year percentage change in sales. This yields 4 growth factors for sales, cash flow, dividends, and book value. Meanwhile, the composite value score is computed for each company using 4 fundamental ratios. The 4 value factors are price to sales, price to free cash flow, dividend yield, and price to book. As with the growth factors, each factor is averaged over a 5-year period. If a company pays no dividends over the relevant 5 years, then the other 3 factors are used for both growth and value. Finally, a factor score is computed as the value of the factor for each company divided by the sum of the factor values for all companies in the universe. In other words, RAFI benchmarks a company's factor score to that of the stock universe from which it is pulled, putting its factor score in context. While RAFI uses only backward-looking metrics to score companies, its use of fundamental weighting methodology is its own major contribution to the ongoing evolution of style indexing. And there's more. The Intellidex suite of indexes used by PowerShares ETFs, for instance, aims to combine growth and value separation with alpha-seeking quant methodologies. These funds use 9 different factors to isolate growth and value stocks, combining both forward and historical ratios to score companies. For investors, the lack of transparency into the methodology used to weight each metric, select companies, and weight constituents is a potential roadblock.
Of course, all the discussion about methodology is really semantics and theory. What matters is what kind of portfolios these indexes create, how you access that as an investor via ETFs in this case, and ultimately how those portfolios perform. So let's look at the real world of growth and value investing and see what kind of portfolios you get out of these different index methodologies. I'm a sector guy at heart. I tend to see things in terms of what companies are actually doing in their individual markets. So this is where I start. This table compares the sector breakdown of 3 large cap value indexes as proxied by their ETFs. IWD, which tracks the Russell 1000 Value Index, IVE, which tracks the S&P 500 Value Index, and RPV, which tracks the S&P 500 Pure Value Index. As you can see, there are really pretty vast differences between the 3 ETFs. Energy stocks account for over 18% of IVE, 12% of IWD, and less than 10% of RPV. The difference between RPV and IVE in the energy case is telling. IVE has 2 times the energy exposure of the pure value ETF RPV. What does that mean? Well, it means that most energy stocks, at least most of the market cap in the energy space, actually live somewhere in the middle lands between growth and value, and are therefore excluded from the pure value component that's captured in RPV. That, after all, is what pure means. The pure index compensates that with significantly more weight in the 2 consumer sectors, particularly consumer cyclical stocks, which make up nearly 20% of the ETF compared to just 7.6% for the traditional value index proxied by IVE. It's also worth noting that the differences between IWD and IVE, 2 classic style indexes that simply use different methodologies. While their sector breakdowns are more similar than we saw when comparing classic and pure style portfolios, even here you can see significant breaks in things like telecom and technology. It is worth remembering that IWD draws from a larger stock universe, the Russell 1000, than IVE, which is from the S&P 500, which certainly contributes to the changing sector breakdown. You can see the change I'm talking about on a single stock basis as well. If you look at the top 10 holdings for all 3 of these funds, they're very, very different. These are funds that purport to follow the same kind of mandate, providing exposure to large cap value stocks. And while IWD and IVE share half of their top holdings, the weightings are markedly different, due in part to Exxon's exclusion from IWD. Its 7% weight in IVE is a huge swing between 2 indexes that provide pretty traditional value exposure to the market. What's even more striking than that, however, is that RPV has 0 overlap with IVE. That is, the pure style S&P 500 ETF has none of the same top 10 holdings as the simple style S&P 500 ETF. No Exxon, no Chevron, no GE. Clearly, the further you get away from traditional methodologies, the more differences you will see in the portfolios. Let's look at it one other way as well. These 3 funds do draw from different kinds of stocks. So at least there's one that pulls from the Russell 1000 and 2 that pull from the S&P 500. But generally speaking, they are all pulling exclusively from large cap companies. But because of the way they select and weight those companies, you come up with very, very different average market caps. The S&P 500 traditional value index tops out with an average market cap of $82 billion. The Russell 1000, as you would expect, takes that down a notch to $64 billion. But the pure value ETF draws all the way down to about $14 billion. There's a certain logic to this, too. As companies become enormous multinational conglomerates, they often stop passing the sniff test for being either a real low price-to-book value company or a high-flying momentum-driven growth company. They end up somewhere in the middle. So these are real important differences, and they matter for returns. Another way to factor this is to think about how this shakes out for the traditional measures that most of us look at when evaluating size and style ETFs. Interestingly, RPV produces the highest average reported PE ratio of the group, despite being the only pure value portfolio. We would note that PE ratios are notoriously prone to statistical anomalies and decisions about calculation methodologies, so I'm not sure that these are apples-to-apples numbers. The other statistics on this screen, price to book, price to sales, price to free cash flow, are based on more standard accounting features. And you can see here that in every case, the pure value ETF, as you would expect, looks more value-y than its competing products.
So how have those tilts translated into performance over the past few years? As you can see in the graph, the performance of RPV was significantly different than that of IVE and IWD, two traditional style funds, whose performances were almost identical. To show that not all alternative style methodologies are created equal, we have included the chart for PWV, the PowerShares Dynamic Large Cap Value Fund. PWV uses more metrics to rank growth and value while following a proprietary weighting and selection methodology, and that produced a different patterns of returns, particularly in the start of the year, than any of the other selections. Here's another way of looking at it. This is 2 years worth of data, and we're looking at the pure version of the S&P 500 style indexes in the bold lines and the mixed versions in the lighter lines. Now the point here isn't to say pure outperforms, although in this case it does. The point is to show the dispersion of returns. Over this period, we see a 21% difference between pure growth and pure value indexes. In the regular style indexes, you see just a 13% difference. Of course, that purity comes with smaller portfolios, and that means increased risk. But if you're really looking to extract the growth or value factor out of the market, it can be a better way to go. Or you can consider correlations. Here we have a chart showing the 2-year correlations between growth and value indexes for 3 families of large cap style funds. This really gets at the heart of what we think investors are looking for in the style space, which is to create buckets of stocks that have meaningful differences between them. As you can see, the correlations are all very high, as you would expect. Remember that correlations measure only whether or not 2 patterns of returns move in the same direction on any given day. And there are a few days when markets produce bifurcated returns. But, as you would expect, the S&P Pure Style Index funds showed the lowest correlations of the group in both the large and small cap markets.
Before we wrap things up and move into Q&A, I want to take a moment just to review the current offerings in the ETF space. There are currently 91 style ETFs available in the U.S., covering a wide range of market caps, regions, and methodologies, so we can't really do more than take a cursory look at them here. Still, we did want to offer a quick overview of the options to give you a feeling for the diversity out there and for the importance of choosing the right fund for you. One place to start is in broad-based U.S. total market growth and value funds, of which there are only a handful really. Over the course of the past year, growth outperformed value, with the Ocean Tomo Growth Index driving the best returning fund in the segment. This is a unique index, which is the industry's first growth-based index that focuses on the value of intellectual property and represents a portfolio of just 60 companies with a quote-unquote highest innovation ratio, which is the highest patent value relative to book value. It's another way that style investing continues to evolve. The large cap space has many more choices, 42 according to our ETF classification system. And over the past year, the best performing fund has been the old favorite, the NASDAQ 100 QQQ from PowerShares. The Qs are another non-traditional growth fund, selecting stocks not based on any growth metric, but rather pulling the non-financial companies that trade on the NASDAQ. It's popularly conceived of as a growth fund, however, so we added it into the mix here. Of the traditional funds, the S&P Growth Fund from iShares was the best in the segment, while the Rydex S&P 500 pure growth fund outperformed even the Qs, beginning a pattern of outperformance for the pure style strategy that, as you will see, spanned all size buckets over the past year. As with growth, the alternative methodologies vastly outperformed the traditional strategies in the value space, with the Rydex Pure Value Index delivering the highest return. It's certainly the pattern of return we saw in the past year. The outperformance of growth was once again on display in the mid-cap space, with all but one of the largest value funds ending up in the red over the past year. What is most surprising here is how much stronger the pure growth fund performed over its peers in the mid-cap space. While this tells you little about the nature of those returns, the key takeaway is that the choice of a value strategy can produce significantly different results. It is not the case, we should emphasize this, that pure value, again, will always outperform, but rather that these funds will perform differently in different markets. Small cap growth once again produced better returns than small cap value. The traditional S&P growth fund outperforms its peers, although the pure growth methodology stood out in the small cap bucket just as it did for large and mid caps. Clearly the year has not been kind to international and emerging market style funds, particularly value strategies. Of your choices here, the fund that performed best was AADR, which selects those companies whose depository receipts trade in the U.S. What this tells us about the nature of the fund's returns, though, is a little unclear, as the use of ADRs, may be an influencing factor on the portfolio. So again, we don't call out these performance numbers to suggest that they will always follow this pattern. Rather, we want to make the simple point that there are lots of choices for investors in the size and style space. The funds and their underlying indexes are not commodities. Instead, there is a wide and significant difference between the various products. In making a choice, investors should take time to consider what they are trying to accomplish and find the fund that's the right fit for them. One critical distinction is whether to take a pure style or traditional approach. The former can accentuate the influence of style factors. They are very growthy growth indexes and value-y value indexes, but they do so at the expense of taking significant tilts and bets away from a core market portfolio. And investors should think carefully about that before they decide where they want to be on the growth value spectrum. So with that, I really want to open up the conversation to our speakers, Ron and Tony. As a reminder to the audience, you can ask questions of any of the panelists at any time using the Q&A window on your screen. Also around this time, we usually get asked whether the slides or a replay of the webinar will be available, and the answer to that is both. They'll be available at IndexUniverse.com within a day or two of this presentation, so you can listen to the whole thing again. With that, I want to bring in Ron Ruff and just sort of ask him a broad-reaching question. I mean, you saw generally how we conceive of the style market from a beta perspective, but I want to know how you incorporate style investing into your practice and sort of how you look at the market and decide what kind of funds you want to use in your portfolio to gain access to the market.
Okay. Thanks, Matt. And by the way, I thought that was a great review of the history of style indexes and where everything is currently. And I appreciated the Men in Black reference that I saw on one of those early slides. In terms of how we use style ETFs in our own at our own firm, I guess I should preface and say that we're a tactical firm overall, and so we're constantly looking for new opportunities, and we're looking for where can we find alpha in the marketplace. So for us, this evolution in the style indexes and the fact that there are 7, 8, 9 different large cap growth indexes available, for us that's just new opportunity. And if we have conviction or if we have a particular viewpoint, then that would lead us to either a pure style index or maybe a more broad-based style index, or maybe an index that has different weightings, whether that's dividend weighting or some other fundamental factor. So for us, it just allows us more opportunity to take a position if we have a viewpoint in a particular area, or if we have high conviction in a particular area, whether we want to go very much pure on the weighting towards growth or value, or if we want something a little more muted.
Okay, great. This is Paul here, Ron. I have a question for you. Can you maybe talk about some of the studies you did and tests of collinearity among the different metrics used to build out these indexes and sort of their independent explanatory powers?
Well, in terms of how we look at these different indexes, what we're interested in, as I said at the beginning, our process is, number one, tactical. So we're looking to take advantage of certain exposures at certain times, and then when the market environment shifts away from that, we're willing to exit that position and go somewhere else. So at any point in time, what we're looking for is, as I mentioned before, the process is follow the money. So what we're looking for is where are we seeing the dollar flows, and if we're seeing, for example, towards the end of last year, we started to see an opportunity in the more growth area, technology. So in some of our more aggressive models, we were putting some pure sector ETFs in the portfolio, technology ETFs. In our more conservative portfolios, we wanted a heavy technology exposure, but we weren't looking for a pure technology. So, for example, we ended up using RPG. It gave us a high technology weighting, but yet it wasn't a pure technology fund, so it was a more muted exposure to technology. So we're not necessarily trying to match up a growth fund with a value fund or a small cap value with a small cap growth. We're looking at where are we seeing the significant dollar flows in the marketplace, and we're just going after those in a more targeted fashion, rather than looking at the broad 9-sector, the 9-box style boxes and making sure we plug in something in every one. We may have all of our equity money in one style box or 2 style boxes, and we may have no money in some of the other style boxes.
That makes sense. I mean, the obvious question I'm sure our audience wants answered then, Ron, is where's your money today? I mean, what's looking attractive to you, and how did you arrive at that decision?
Okay. Well, I'll give you 2 answers. In terms of where are we right now, we're very defensive, i.e. cash, corporate government bonds. We're actually inverse the market in a few areas. So we're very defensive right now because as everyone knows, the market has rolled over. So we're in a very defensive posture. Now, the way I'll answer that question is to say, looking forward, where do we think the opportunities might be coming from? And I would say, if this market can hold, above 1120 and this thing rebounds through the end of the year, then I think large cap growth is probably one area that would probably bubble up on our radar pretty quickly. And if the evidence of an economic recovery start to play themselves out, we start to see the numbers picking up, the LEI numbers don't roll over, then I could also see small caps as being an area that we would be looking at, coming into the fourth quarter. But right now, we're actually in a very defensive posture.
Yeah, that's interesting. I mean, I often see advisors sort of rolling through the style spectrum as they gain confidence, that the economy is truly back on track. They move, from the safest securities in the large cap growth space and then on down. I wanted to bring in Tony here, and you just heard how Ron uses style ETFs in a portfolio. I guess from your perspective, how do you hear from advisors about what they're doing with style ETFs and the way they integrate them into portfolio and asset allocation policies?
Yeah, thanks, Matt. And I would echo Ron's comments. I think this is very, very helpful and very insightful. And in fact, one of the things that I think we spend a lot of time with advisors on is just understanding what it is that you're getting. You're not necessarily getting the exact same ride. What we do hear from advisors is many advisors like Ron are more tactical oriented, either looking at market signals. If there's a clear growth environment, we believe you'd be better off in a pure growth strategy. Others who are really beholden to the style boxes, people are trying to get the isolated pure exposure to the 9 style boxes or 6 style boxes, however you break it up. And we do see a lot of folks thinking about that. I think historically it has been more of a tactical trading strategy, much like Ron has described, although people might have their own individual rules on when and how they're changing their exposures over time.
All right. What do I have to do?
Yep, I mean that definitely makes sense. I guess one of our questions, getting away from that tactical approach a bit, is there seems to be a hole in the market for a total market pure ETF or index. Is that something we're likely to see at some point?
We're always listening to the market. Our best ideas come from our advisors. I do think that although most advisors have typically thought of these strategies as more tactical, I think as you and I have shared in the past, I'm a big fan of pure style because I think it really gets you the pure exposure that you're looking for. And if people spend the time, as you've done on this call, and really dissecting the returns and the types of exposures that you get, and that muddiness that exists across a lot of the indices where you're really getting a lot of value in your growth and a lot of growth in your value, I would argue they really do represent, pure, as they say, pure exposure to the underlying asset classes. And you could certainly make the case that they actually belong as a way of making those calls on your asset allocations. And I'd argue, rather than just think of them tactically, they could be viewed tactically as well as better or pure exposure to the underlying asset classes. And that's an educational process, and we think it's healthy to have calls such as this and engage people on it.
So Tony, this is Allison. One of the questions that's come in is how much importance does the ETF fund size and how does that affect the style ETF return?
I'm not sure. Is that from a trading perspective, or I'm sure I understand the fund size per se?
I think the question, is asking for assets under management and perhaps also from a liquidity standpoint as well, but definitely AUM.
Yeah, and I think that's a challenge in the industry in general. We often hear that, I'm not going to be trading a strategy unless I see significant assets or significant volume. Again, the underlying liquidity is the most important determinant of the liquidity. We think these are actually quite liquid. We actually had a call, I think last week, with another tactical firm who talked about making a $10 million allocation in one day, and he was commenting that it was done, pennies above the market. And again, I would encourage those who can to take advantage of liquidity providers in the market who can help facilitate larger transactions. But we believe all of these strategies are very liquid, very easy to trade, and we don't get a lot of pushback from people, the basic pushback about assets under management and volume, but we actually think that those are actually proficient traders in the market, and those who are working with liquidity providers actually feel they get a pretty solid execution.
So here's another question from the audience. What importance do you give to tracking error, and how do you monitor it? For Tony.
To me, it's always an interesting starting point, tracking error relative to what? Clearly, as we kind of expand and move away from the traditional indices, is a tracking error relative to the S&P. We would expect to have a large tracking error because we're designed to be different. But I do think that there should be attention given to tracking error relative to the underlying index. And tracking error relative to the underlying index obviously sometimes has to do with liquidity. So as Ron was mentioning, and I'm writing notes because we do want to respond to the market, one of the issues that you might foresee if you start to get very granular and looking at international small cap and emerging small cap value is you might have tracking error because you're ultimately going to be dealing with very thinly traded illiquid securities. So I think before even venturing into a market, you have to anticipate some will be more prone to tracking error than others. I think for advisors, they should be aware of it, they should follow it, but I think they should have a higher tolerance in certain of the very narrow niche segments, and you shouldn't expect a lot of tracking error in the larger, more liquid sectors of the market.
Right. This is Matt. I'm going to throw one back to Tony. Obviously one of the great things about your products is they do isolate, the growthiest growth stocks and the valuiest value stocks. Can you talk a little bit about how, investors or advisors might monitor the risks they're taking to the market?
Hey.
I think there's another conversation going on. No, but as far as monitoring the risk in the portfolio, I would say, Matt, I thought you did a terrific job going through the portfolios in general. And again, I think that's the one thing we want to make sure that people think about. When you're getting pure style exposure, although the returns have been very impressive, they're not necessarily going to be exactly like the underlying benchmark, or if you're looking at a large cap growth benchmark, it's going to be very different. So we would always recommend that people take that into consideration. We'd argue you're rewarded for the risk that you take with the excess return, but it means you are going to have a slightly different ride along the way. So again, I think educational forums like this are very helpful so people understand that the composition of the portfolio is likely going to be different. You might have different sector exposures. As you pointed out, you're going to have different capitalization exposures. I think if everyone enters into this with a more knowledge-based approach, everyone's going to win. Everyone's going to be better off.
Yep. And Ron, one question I wanted to ask you, we mentioned the Qs as an example of a non-traditional style index. We lump that into the growth indexes, even though that's not inherently what its focus is. What do you think of a portfolio like the Qs? Do you think that should be considered in the growth camp, or is its underlying methodology too far afield from targeting actual growth exposure? What do you do with the Qs in your practice?
We do include the Qs in the growth, on the growth side of the spectrum. If we're looking at things along the 9-box style box universe, we would put that in the large cap growth. But we also look at it as having within the growth side, large cap growth, having certain overweights, primarily technology. I mean, what is Apple, 20% of that index?
Right.
So before we would go there with money, we would want to have pretty good conviction about the technology space in general and Apple in particular. And so we would probably only use it, A, when we had that conviction, and B, it would probably be for some of our more aggressive models.
Right. No, that definitely makes sense. And then, one question back to you, Tony. I know there are no products or indexes in this space, but, as we look out in the future, we think about style indexes internationally. Are there concerns with the quality of the accounting data, say in an emerging market like China, that might muddy the waters, or do you think that the style statistics are standardized enough that you end up with good, decent portfolios?
I'm really not sure. We have been working with our index providers looking at different ways of slicing and dicing the world, and I think you raise an interesting point with different accounting standards. The other thing is, do you really see a discernible difference between value and growth characteristics? Certainly in the emerging markets, you're getting much more of a small play. There aren't a lot of big companies other than if you somehow think that Samsung is an emerging market company, they're clearly large cap. So I think as we're looking in the space and we're working with the index providers, we are sensitive to the purity of what we're actually capturing there. But I do think, as Ron indicated, there seems to be more and more interest in breaking the world into finer, more bite-sized pieces. So we'll continue to look at it. We'll continue to work at it. If we get comfortable that it works and we can bring great products to the marketplace, we'll absolutely do that.
That's great. I'm going to answer one question we've gotten from the audience, and then a number of times. Then I'm going to ask Ron one question to close. So we've got a lot of questions about the best place to go to see the difference between same style ETFs. We're certainly working on documentation here at IndexUniverse, summarizing many of the statistics and methodologies we pulled out in today's webinar. So, stay tuned on IndexUniverse for some sort of central location you can go to review this information in summary format. So thanks to everyone asking those questions. And then, Ron, I want to return, to something you mentioned at the offset. I remember you mentioning dividends. And dividends are certainly one way that people approach value investing. I guess I have a two-part question to you, which is first, is dividend and high dividend yield investing, does that fit into your framework of sort of tactical allocation from the growth to value spectrum, and if so, how? And then second, are there any concerns just about sort of the huge rising popularity of those funds and whether people are piling into the dividend market because it's the only place to find yield?
Right. Well, on the first part, there are times when we're attracted to high dividend paying companies, therefore high dividend paying ETFs are attractive to us. And it might be during an environment where we want some equity exposure, but maybe we're a little nervous, so we're not ready to go into a pure growth or pure small cap type investment. We want something with a bit of a cushion on it in case I hate to use the word timing, but in case our timing is wrong and the market, sort of gives way underneath us. Funds with the dividend yield they're typically a little bit lower beta, a little bit more conservative. So there are times when we do like to look for those kind of securities. In fact, I would say coming into this year, that was exactly our attitude. And in fact, we did have in the portfolio, in our equity part of the portfolios, we had a fair amount of equity income, more dividend-oriented funds in the portfolios. In terms of your second question, which was, repeat that again?
Well, I was just talking about that we've seen so much media focus and so many investors focusing on dividend ETFs and dividend-paying stocks. Is there a worry that that market becomes crowded?
Absolutely. I mean, it's always the case that an area that gets a lot of immediate attention, a lot of focus from the strategists on Wall Street, and starts to leading Main Street into those areas, that area is approaching the end of its run. So we're always, as a firm, we're always nervous, but when you look at areas of the market that maybe are starting to get pushed into a little bit too much, I think you'd have to look at this dividend focus as being one area that could be getting overdone. Now, today there are a lot of options. I mean, it used to be when you think of dividend-oriented companies, you're basically looking at large cap value was the style that you're talking about. But today, the universe has dividend stocks in almost all of the 9 boxes, and overseas as well. And even emerging markets now, you can find equity income-oriented emerging markets companies. So it's a pretty broad universe, but as with all things, once everyone has gone there, then there's not a lot of future growth left. I'm not sure I would say that that's where we are. I think given today's low interest rate environment, people are just hungry for yield, and we're being pushed out on the risk curve to find it, and we're not finding it in a 10-year treasury, so we're looking pretty far out the risk curve. That could have an ugly ending eventually, and I'm not sure that I would say it's today, but we're certainly going in that direction.
Absolutely. Unfortunately, with that, we've run out of time. I'd like to thank my co-panelists, Paul Baiocchi from my own firm, Tony Davidow from Rydex, SGI, Guggenheim, as well as Ron Ruff from Financial Services Advisory. For more information, you can go to our websites, IndexUniverse.com, Rydex-SGI.com, or FSAinvest.com. Thank you for joining us. This is a part of a continuing series of webinars. You can find out more at IndexUniverse.com about what's coming on. Thank you again. We'll see you next time.
Matt, are we staying on?